Breaking news for Singapore investors. The latest Singapore savings bond results are out, and they paint a concerning picture for local savers. The May 2025 SSB tranche saw applications fall dramatically short of the $500 million offered, with only $303 million in total applications. This marks the second consecutive month where demand has failed to meet supply. Here's what's really worrying. The 10-year average return has dropped from 2.69% in April to just 2.56% for the June tranche. That's the same low level we saw back in October 2024. The first-year interest rate also fell to 2.2%, down from 2.49% last month. For context, Singapore savings bonds have traditionally been the go-to safe investment for Singaporeans, especially those looking to diversify beyond their CPF accounts. These bonds are backed by our takeaway-rated government and offer the flexibility to withdraw any time without penalty. But the declining returns and weak demand suggest investors are losing confidence in this supposedly safe haven. This trend mirrors what's happening globally. Major economies are facing a bond crisis as investors demand higher returns to compensate for increased risks. Even Japan, which holds over $1 trillion in U.S. treasuries, has been selling off massive amounts of American government debt. When the world's safest investments start looking risky, it affects everything from your CPF returns to housing loan rates. For Singaporean investors, this creates both challenges and opportunities. With SSB returns now below inflation expectations, you might need to reconsider your asset allocation strategy. The traditional approach of parking money in government bonds for safety is becoming less attractive when those bonds offer diminishing real returns. What should you watch for next? Keep an eye on the upcoming Federal Reserve decision on June 18th and how it affects Singapore's monetary policy. The MAS has already made adjustments this year to support our economy, but global bond market stress could force more changes. Also monitor whether SSB demand continues to weaken in coming months, as this could signal a fundamental shift in how Singaporeans view government bonds as an investment option. The message is clear. The era of guaranteed safe returns from government bonds may be ending, and Singapore investors need to adapt their strategies accordingly.